Ready to invest? Hold your dollars for just a moment. There are uncomfortable truths about the market that most experts won't reveal. The dark side of investing that could make or break your financial future. 90% of day traders lose money. The average investor underperforms the market by nearly 4% annually, and you absolutely don't want to be part of these numbers. So the question is, how do we make sure you don't fall into these traps? Stick around. And, by the way, if you're new here, hit that subscribe button and tap the bell. This channel talks about this kind of stuff all the time, and it would be a shame for you to miss out on future videos that might save your portfolio. That being said, let's get started. Fact number 1. Investing is a mental game, not a mathematical one. When people find out someone invests in the stock market, they often say something like, "You must be great with numbers," or "I bet you're a whiz with calculations," but nothing like that. The truth is that investing is only about 20% math and 80% psychology. The math part? A 10-year-old with a calculator could handle it. The real challenge isn't calculating PE ratios or dividend yields. It's managing the voice in your head that screams, "Sell everything," when the market drops 3% in a day. It's fighting the urge to pour your money into a stock that's gone up 300% because everyone on social media says it's going to the moon. Like, most of us know intellectually that we should buy low and sell high. Yet study after study shows that the average investor does exactly the opposite. Why? Because fear and greed hijack our decision-making process. Take March 2020, when the market crashed at the beginning of the pandemic. Mathematically, this was a buying opportunity of a lifetime. But psychologically, it felt like financial suicide to buy stocks when the world seemed to be ending. The winners? The ones who could control their emotions when everyone else was panicking. Before you dive deep into perfecting your spreadsheet models, take a moment to ask yourself, can I stay calm if my portfolio drops by 30%? Can I avoid jumping on that hot stock everyone's raving about? Can I stick to my plan when it feels like everything's falling apart? These mental questions will have a bigger impact on your investment success than any formula for compound interest. The second truth you need to accept is this: you will make mistakes. A lot of them. Not might, will. I don't care how many books you read or courses you take, you're going to mess up and it's going to cost you money. Experienced investors have been investing for years and they still make mistakes. They've bought at market peaks. They've sold promising companies too early. They've held losing positions too long. They've missed obvious opportunities that were staring them in the face. What separates successful investors from unsuccessful ones isn't a magical ability to avoid mistakes. Notice how it's said magical, because it is kinda impossible to avoid those. So, what matters instead? It's how they respond when those mistakes inevitably happen. Most people do one of two things when they make an investment mistake. They either beat themselves up about it, destroying their confidence, or they refuse to acknowledge it was a mistake at all, learning nothing in the process. Both reactions are portfolio killers. The unsettling truth is that mistakes are tuition payments in your investment education. The question isn't whether you'll pay this tuition, it's how much and what you'll learn from it. The priciest investment lesson is the one where you keep making the same mistake because you refuse to learn from it the first time. The people who end up saying things like, "the market is rigged" or "investing doesn't work," are usually the ones who didn't learn from their own mistakes. So what should you do instead? Be brutally honest with yourself about what went wrong. Was your strategy off? Did emotions mess with your decisions? Did you ignore warning signs because you were too caught up in the potential gains? It's uncomfortable, yes. Nobody likes facing their mistakes. But in investing, that self-reflection pain is a lot cheaper than the pain of making the same mistakes over and over again. Now, third fact, taxes aren't a bad thing. And yes, this is a pay your taxes warning. Better you know this now. People are so afraid of paying taxes that they make decisions that actually harm their net worth. See, taxes are the price of admission for making money. If you're paying taxes on your investments, congratulations, you're winning. You only pay taxes when you make money. Many investors have seen people hold onto a stock that's up 500% just to avoid paying capital gains tax. only to watch it crash and end up with less than if they'd sold and paid the tax. They've also seen people shy away from great investment opportunities just because they heard there's a tax issue. Let's set the record straight. Tax efficiency is important, but avoiding taxes shouldn't be the main reason behind your investment choices. What really matters is your total after-tax return. Here's a simple way to think about it. Would you rather make $100,000 and pay $30,000 in taxes, or make $50,000 and pay $10,000 in taxes? In the first case, you're left with $70,000. In the second, you're left with $40,000. A higher tax bill can actually mean a better outcome for you. The best investors out there get the tax stuff right, use tax-friendly accounts like 401k and IRAs, and focus on making smart investment choices. They don't let taxes drive their decisions. Fourth fact, investment strategy hopping is a recipe for poor returns. Yet it's exactly what most people do. The investing world is full of flip-floppers, people who jump from growth stocks to dividend stocks, to value investing, to crypto, to whatever's hot this month. Each time they abandon their previous approach before it has time to work, and each time they convince themselves that this new approach is the one. Here's what happens. They buy growth stocks at peak valuations, sell when they drop, then switch to safer dividend stocks. Once the market starts roaring again, they abandon dividends for the next hot trend. Each transition usually happens at exactly the wrong time, buying high and selling low over and over again. Do you think Warren Buffett became the world's most famous investor by constantly changing his approach? Not a chance. While his style has evolved over time, the core principles have stayed remarkably consistent for decades. When the dot-com bubble was inflating and everyone called him obsolete for not jumping on tech stocks, what did he do? He stuck to his value investing principles. And when that bubble burst, everyone suddenly remembered why Buffett was the Oracle of Omaha. Look at any successful investor out there. They rarely have the flashiest or trendiest strategy. What they do have is consistency. They pick a reasonable approach and stick with it through good times and bad. Consistency almost always beats trying to optimize every little thing. This doesn't mean you can't refine your approach as you learn more. But there's a huge difference between refining a strategy and completely abandoning it. Refinement shows growth. Abandonment usually just shows you're chasing performance. Next thing you should know, the investment industry thrives on complexity. Why? Because complexity can be marketed, packaged, and sold at a premium. It makes the seller look smart and justifies higher fees. But simple investment strategies outperform complicated ones over the long run. Study after study has shown this. You've probably met someone like this. They've got spreadsheets with 17 different technical indicators, complicated sector rotation schedules, and option strategies that require a finance degree to understand. They're glued to their computer 20 hours a week managing all this. And guess what? They're still getting beaten by basic index funds. It's kind of funny, right? When you look at most people who've actually built serious wealth through investing, their approaches are surprisingly simple. No fancy algorithms, just basic principles. Diversification, keeping costs low, putting money in consistently, and having the patience to let it grow. But here's why this truth makes people uncomfortable. We naturally want to believe there's some secret formula or hidden pattern that'll give us an edge. There has to be a complex system that delivers superior returns, right? Except there isn't. Markets are just too efficient and unpredictable for complexity to win consistently. It's not something you want to hear while you're preparing all your investment for dummies books, right? And we're not done yet. Fact number 6, not all risks are created equal. Some risks come with appropriate potential rewards, while others are just Russian roulette with your money. The uncomfortable truth is that you need to take some risks to grow your wealth, but you need to be selective about which risks you take. Ever notice how someone will say the stock market is too risky, then turn around and dump money into some random crypto project because a YouTuber promised they could 10x their money? Yeah, it's like refusing to swim in a pool because you might drown, then heading straight into the ocean during a hurricane. Here's what matters: knowing the difference between smart risks and reckless gambles. Smart risks have decent odds, fit your strategy, and you're not betting too much. Reckless gambles? unknown odds, pure speculation, and often money you can't afford to lose. Now let's talk about something we've all done. Fact number 7, comparing our investment returns to others. With social media, this has gotten completely out of hand. Scroll for 5 minutes and you'll see people bragging about their 1000% gains and perfectly timed trades. See, if you compare yourself to others, that is a path to failure. These posts are like highlight reels. Nobody's posting about their losses or failures. Even when the gains are real, they're usually more about lucky timing than actual skill. What happens? People ditch perfectly good strategies that are working for them just because someone on Reddit claims to be doing better. That's a fast track to nowhere good. The only question that really matters is simple. Are you on track to hit your personal financial goals? That's it. Not whether you're beating your brother-in-law or some random influencer's claimed returns. Successful investing is a personal journey. Learn from others? Absolutely. But measure yourself against their carefully curated highlight reel? That's a game you'll never win. Look, you won't hear these truths from the gurus selling get-rich-quick schemes. They're not flashy, but if you know them well, they work. Do just these things, and you're already beating most investors out there. Thanks for watching. If this helped you, smash that like button and subscribe for more no-nonsense investing talk. Until next time.